Welcome to The Explainer. Look, for all of you focused learners out there who love unpacking the mechanics behind these massive market shifts, you're in for an absolute treat today. We're looking at a company that is sitting squarely at the intersection of the most explosive trend of our generation, the AI data center gold rush. We're talking about Bloom Energy. Over the last few months, they've been on an absolute tear, turning heads from Wall Street straight to Silicon Valley. AI requires a frankly unimaginable amount of electricity, and Bloom Energy has positioned itself as the critical valve to release all that power. 409%. Yeah, you heard that right. That is the massive, jaw-dropping return Bloom Energy stock has delivered over the past year. And honestly, it gets even crazier. In just the first half of 2026 alone, the stock spiked over 248%. We're talking about the kind of explosive, vertical trajectory that completely defines a generational market frenzy. It's a rocket ship, plain and simple, and it's being driven by the insatiable, power-hungry nature of artificial intelligence. But this brings us to the absolute most important question for anyone looking at this stock today, and really the central theme of our explainer. Is this still an undeniable buy, or has it just run way too far, way too fast? Whenever a company's valuation shoots to the moon in a matter of months, we really have to pause. We have to ask ourselves, are we looking at a fundamental, permanent shift in the energy landscape, or is this just another overhyped story riding the coattails of an AI buzzword? To figure that out, we have to understand the specific, real-world problem Bloom Energy is actually solving. Okay, let's dive right into this core conflict. Why is there this sudden, desperate scramble for Bloom's technology? Well, the thesis is actually incredibly straightforward. AI data centers are being built at breakneck speed. They need massive amounts of power, and honestly, they needed it yesterday. The problem is, if a tech giant wants to plug a shiny new billion-dollar data center into the traditional power grid, they are facing agonizing delays. We're talking about waiting anywhere from 53 to 59 months just to get a grid connection. That's nearly 5 years. And in the AI arms race, a 5-year delay is literally a death sentence. But Bloom Energy's solid oxide fuel cells offer a rapid, behind-the-meter solution. That means they generate power right on site, using natural gas or biogas, completely bypassing those massive grid delays. They give data centers the juice they need, right where they need it, in a fraction of the time. Section 1, the bull case. Explosive growth. And man, the financial numbers backing up this hype are nothing short of explosive. In Q2 2026, Bloom Energy reported a record quarterly revenue of $1.065 billion. That is a staggering 166% year-over-year jump. This wasn't just some modest incremental beat. This was a complete shattering of expectations, and it was driven primarily by a massive 215% surge in product revenue alone. It just shows that companies aren't just, talking about buying Bloom's fuel cells. They're actively signing the checks and taking delivery at an unprecedented scale. And who exactly is writing those checks? The absolute titans of the tech and AI infrastructure world. We are talking about major blue-chip partnerships that totally validate the technology. CoreWeave, Oracle, Nembius. These are the heavy hitters building the actual backbone of the AI revolution, and they're signing significant, needle-moving deals with Bloom Energy. These aren't cute little pilot programs. These are massive deployments that are directly fueling that unprecedented revenue beat we just talked about. And this top-line explosion? It translates straight to the bottom line, too. For Q2 2026, Bloom posted a non-GAAP earnings per share of 78 cents. Now, to put that into perspective for a second, Wall Street consensus was sitting way down at 41 cents. They didn't just beat earnings expectations, they practically doubled them. When a company crushes consensus estimates by that kind of margin, it literally forces the entire market to go back and completely reevaluate their financial models. So with that kind of crazy momentum, management's confidence is understandably sky high right now. They aren't treating this as some one-off lucky quarter. In fact, they've raised their full-year 2026 guidance for the second time. They're now projecting full-year revenue to land somewhere between $3.9 and $4.2 billion, with operating income soaring to between $800 and $900 million. And as you'll see in a second, this massive operational success is attracting some very serious institutional muscle. Which brings us to this incredible figure, $25 billion. This isn't just projected revenue. This is raw institutional backing. Their financing deal with Brookfield Asset Management, which is a global giant in the infrastructure space, was recently expanded from a very respectable $5 billion to a massive $25 billion. That is a tremendous signal to the market. It means deep-pocketed, smart, institutional money fundamentally believes in Bloom's long-term role in building out global AI infrastructure. Unsurprisingly, Wall Street analysts are pretty much singing the exact same tune. The consensus rating across the board right now is strongly buy or overweight, with average price targets floating around $275. But the top-tier analysts from heavyweights like UBS and JP Morgan, they're projecting even more massive upside, maintaining price targets as high as $300 to $314. From a purely bullish perspective, the sky seems to be the absolute limit here. Section 2, the bear case, valuation and grid threats. Now, let's take a step back, take a breath, and look at the other side of the coin. Because the biggest concern right now for any objective investor is simply the price tag. Just look at this multiple, 21.8 times. That is Bloom's current price-to-sales ratio. Now, sure, while some discounted cash flow models might suggest there's still value here based on all that future growth, a 21.8x multiple is towering far, far above the industry average. It's well past the estimated fair value of roughly 14x. When a stock trades at a premium this steep, it is essentially priced for absolute perfection. There is zero margin of safety. Any slight miss in an upcoming quarter, or even just a shift in the broader macroeconomic winds, could trigger a really sharp, really painful correction. And then there's the biggest existential threat to Bloom's explosive growth, time itself. Right now, in the present moment, we have an acute power shortage. That's exactly why Bloom is winning. But data from S&P Global paints a very clear picture of the near future. A massive amount of new traditional grid power, over 300 gigawatts, is expected to come online by 2030, with a huge wave of that power hitting the market right around 2027 and 2028. The grid is slow, for sure, but it is moving, and eventually it is going to catch up. Which leads us to a fascinating and honestly pretty provocative question. Once that 300 gigawatts of new grid power finally comes online, what happens to Bloom? Do they remain a critical, must-have primary power solution, or do they kind of get downgraded to just a niche backup or a resiliency provider? If these AI data centers can finally get their hands on cheaper, traditional grid power in 3 or 4 years, Bloom's exceptionally steep growth trajectory might not be nearly as sustainable as that 21.8x multiple demands. And some folks on Wall Street are already starting to flag this exact risk. Wells Fargo, for instance, recently downgraded the stock. They lowered their price target to $176 with an equal weight rating. Their argument? They're suggesting that much of the massive upside from that $25 billion Brookfield deal is actually already fully priced into the stock. And, that's a classic textbook sign that a stock might be running well ahead of its actual underlying fundamentals. Section 3. The bottom line, synthesis and verdict. So we have an incredibly compelling bull narrative matched right up against a highly cautious bear narrative. The crucial point here is how you personally weigh these specific factors. The bulls, they see a unique, critical enabler of the AI revolution solving a massive multi-year pain point. They're looking at a huge backlog, potential DCF upside, and a $25 billion catalyst that pretty much guarantees their runway. But on the flip side, the bears see a stock priced for absolute perfection. They see that 2027 grid catch-up as a looming brick wall, and they're quick to point to the stock's highly volatile beta of over 2. And if you know beta, you know that means you must be prepared for some violent price swings in both directions. And that really brings us to our final takeaway. As this quote perfectly summarizes, ultimately, Bloom Energy is a high-conviction, high-risk play on the AI infrastructure build-out. If you're out there looking for a safe, steady, sleep-at-night value stock, well, this simply isn't it. This is a premium growth story, and it is entirely dependent on the belief that the AI power shortage is a structural, multi-year problem that only Bloom is uniquely positioned to solve right now. The data is incredibly clear. The catalysts are massive, but man, that premium is high. For some investors, the current price is just the cost of entry to get into the future of AI energy. But for others, it's a glaring signal to just watch safely from the sidelines until the valuation cools off a bit. So I want to know where you stand. Looking at the reality of the grid delays versus that massive 21.8x multiple, are you bullish or bearish on Bloom Energy? Let me know your verdict in the comments down below. Thank you so much for hanging out with me to explore this fascinating explainer. Keep learning, stay focused, and I'll catch you in the next one.